How's it going, wealth builders? This is your king, and you're tuned into Elite Finance King. Welcome to the Pride. Let's get right into it. Today, come and join your king in a new episode where we dive into the three popular and game-changing investment options: ETFs, mutual funds, and index funds. We will cover their key similarities and differences. Whether you're an experienced investor or just starting out, we've got you covered, wealth builders. Your king will surely help you decide which one suits your preferences and goals. So, without further ado, let's jump in. Alright, wealth builders, before discussing our main topic for today, it's always a good idea to define these three investment options to help you get a better understanding. Let's start with the first one: ETF. An ETF, or exchange traded fund, is a type of investment fund that's traded on a stock exchange, just like a regular stock. They're known for their low fees and flexibility. On the other hand, a mutual fund is a type of investment vehicle that pulls money from many investors and uses it to buy a diversified portfolio of stocks, bonds, or other securities. These funds are managed by professional and bright fund managers. Lastly, an index fund is a type of mutual fund or ETF that aims to replicate the performance of a specific market index, like the S&P 500. They're known for their low fees and passive management style. You see, each of these options has its own unique features and benefits, and that's the assignment of your king today, to let you understand it. So, let's dive deeper into their similarities and differences. Let's start with the first similarity: professionally managed. Wealth builders, when you invest in ETFs, mutual funds, and index funds, you're handing over your hard-earned money to professional money managers. These are seasoned experts with extensive knowledge of the financial markets, and they're tasked with making informed investment decisions that align with the fund's objectives. For many investors, even your king here, this is a huge relief as it takes the pressure off having to constantly monitor and manage our investments. You see, the role of the professional money manager is to ensure that the fund's objectives are met. This means that they will carefully select a mix of assets, such as stocks, bonds, and other securities, that they believe will help the fund achieve its goals. They will also keep a close eye on market trends and economic indicators, making adjustments to the fund's portfolio as necessary to adapt to changing conditions. Cool, right? This can be especially advantageous for investors who may not have the time, knowledge, or inclination to actively manage their investments. With a professional money manager at the helm, you can feel confident that your money is in capable hands, allowing you to focus on other aspects of your life without worrying about the day-to-day ups and downs of the market. Now, for their second similarity, let's talk about diversification. Wealth builders, all three investment options, ETFs, mutual funds, and index funds, offer diversification benefits. By pooling money from multiple investors, these funds can invest in a broad range of securities, such as stocks, bonds, and other assets like mutual funds. ETFs in particular are known for their broad diversification. They typically track an index, which means they invest in all or a representative sample of the securities in that index. This allows investors to gain exposure to a wide range of assets, industries, and geographies with a single investment. Mutual funds also offer diversification, but they may be actively managed, meaning a portfolio manager selects the securities based on research and analysis. Index funds, on the other hand, are similar to ETFs in that they track an index and offer broad diversification. However, they are structured as mutual funds, which means they are bought and sold at the end of the trading day at the net asset value price. This makes them a bit less flexible than ETFs, but still an excellent choice for investors seeking diversification. In summary, wealth builders, diversification is a key feature of ETFs, mutual funds, and index funds, helping us investors manage risk and build balanced portfolios. The last similarity that your king noticed between these three is the remarkable liquidity. Wealth builders, both ETFs and mutual funds boast a high degree of liquidity, which allows investors like us to swiftly and smoothly buy or sell shares of the fund. This liquidity is a crucial feature, particularly for investors who might require speedy access to their funds, or who wish to have the flexibility to adapt their investment portfolios as per their needs. In the world of ETFs, trading is as simple as buying and selling stocks. They're traded on an exchange just like stocks, allowing for real-time trading throughout the day. This means that investors can react quickly to market changes, seizing opportunities or limiting losses as they see fit. It provides a level of control and immediacy that is often appreciated by active investors. On the other hand, mutual funds and index funds might not have the same level of intraday trading as ETFs, but your king will assure you that they still offer considerable liquidity. Mutual funds are typically priced at the end of the trading day, and investors can buy or sell shares at this daily net asset value. Index funds, which are a type of mutual fund that seeks to track the performance of a specific market index, also shares this liquidity characteristic. This ensures that investors can get in and out of their positions with relative ease, contributing to the popularity of these investment vehicles. Now, we're done with their similarities. It's time to start uncovering their differences, particularly in terms of trading and liquidity. Wealth builders, one major distinction is how they are traded. ETFs, or exchange-traded funds, operate similarly to stocks. They're traded on an exchange and can be bought and sold throughout the trading day at market prices. This allows investors to respond quickly to market changes. On the contrary, mutual funds are a bit different. They are traded only at the end of the trading day at the net asset value price. This means you don't get real-time pricing with mutual funds. Lastly, index funds, which aim to mimic the performance of a specific market index, can be structured as either ETFs or mutual funds. This gives investors flexibility in choosing a trading structure that suits their needs. Another notable difference between these three investment vehicles lies in the realm of minimum investment requirements and fees. When you're looking to dip your toes into the world of investing, mutual funds might require a bit more from your wallet to start with. They often come with higher minimum investment requirements compared to ETFs and index funds. But that's not all, wealth builders. Mutual funds also tend to have higher expense ratios. Why? Because they're actively managed, which means there are professionals behind the scenes making decisions on where to invest the money. On the flip side, ETFs and index funds are usually more cost efficient. They typically have lower fees because they follow a more passive approach, simply tracking the performance of a specific index. So, if you're looking to start investing without breaking the bank, your king suggests that ETFs and index funds might be more up your alley. Now that we've covered the similarities and differences between ETFs, mutual funds, and index funds, here's a question for you, my loyal wealth builders. Which investment option do you think is the best fit for your investment goals? Let your king read your answers in the comments below. Maybe we have the same taste in terms of investing. So there you have it, my loyal wealth builders. If you found this video valuable, please like, subscribe, and share it with your fellow financial dreamers. Your king here appreciates that. Until next time. And always remember, Pride members, life is short and it's too easy to be average. Make a change today.